Hey everyone, Dave here with another installment of our Investing Basics series. Today we're talking about buying and selling stocks and ETFs. So our agenda, we'll cover basic and advanced buying techniques, same story on the sell side, basic and advanced techniques there, and then just a programming note. Everything that I talk about and the words that I use in the presentation say stocks, but just know that we're also talking about, and these rules apply to ETFs or exchange traded funds as well. So we'll go to buying. So there's some homework that you have to do before you get started. One is choosing a trading platform. And in 2023, the top four are currently Charles Schwab, Fidelity, E-Trade, and TD Ameritrade, although that's soon to become a top three because TD Ameritrade is about to merge with Schwab. Once you've done that, you need to determine how much you have to invest. If you're just looking at one company to get started, you want to make sure that you not invest any more than 10% of your entire portfolio in that single stock. We don't like putting all of our eggs in one basket, and we don't like putting all of our money in a single company. Now you're ready to get started. You can log into your trading platform and check and see how much the shares of the stock are trading for. So here's an example. You have $1,000 to invest and you want to buy shares of company A. Company A happens to be trading today at $100 per share. And so you can buy 10 of those $100 shares equals that $1,000 investment that you'd like to make. So let's look at the actual buying. So there's lots of times if it's a large company, very actively traded, not moving around a whole lot, minute to minute, you can just say, hey, I want to pay whatever the prevailing rate is. So when your trading platform asks you what type of order you'd like to place, you can select market. And then that means as soon as you press buy, your stock will execute and the trade will execute at whatever the current market price is at that moment. However, there may be instances where you want to set limits on the price you'll pay, maybe a maximum of what you're willing to pay. And it can be, if it's an example of a small, thinly traded stock where the price is moving around quickly in large chunks, you don't want to overpay for that. Maybe you've done your research, you're looking at certain metrics, and there's a maximum that you're willing to pay based on those metrics, and you want to make sure that your trade executes below that. And then finally, if you happen to have a trading platform that allows you to place orders outside of market values, you definitely want to set a limit there because often sellers will inflate their prices after market because not much trading is going on, and sometimes they can command a much higher price from unsuspecting investors. So when you're looking at these kinds of circumstances for the type of market order or the type of order you'll place, you'll choose limit rather than market, and then you'll specify the maximum price that you want to pay in terms of dollars per share. Now, there's a whole bunch of different types of limit orders, and it can depend on what you're looking for. Maybe you only want the limit order open for a single day. Maybe it could be months. Maybe you want it open for months, plus you don't care when it executes, either during market hours or after. And so once you specify that you want to do a limit order, your trading platform will then prompt you, well, when do you want it to expire? And so these terms and numbers and words are different across all trading platforms, but many of the definitions are the same. So if you're placing an order that is day, it's only good for that trading day. Good till date, let's say you want to make it for a week from now, you're happy to get it anytime the next week. So it's good until the date you specify. Good for 6 months is good till 6 months, GT6M. That's the code there. And then I don't know why this also isn't GT6M plus extended hours, but whatever. TD Ameritrade's is good till canceled is what they're meaning there, plus extended hours. So that will set the limit order for 6 months, and it can be satisfied either normal trading hours or during extended trading hours. All right, let's look at selling. Many similarities here. So you may own a stock for months or even years, but at some point you'll probably want to sell it. You'll want to decide if you're selling all of your shares or some of them. Often trading platforms make it convenient to sell all. They will sometimes have a checkbox for sell all shares, so you don't have to look up how many that you have. And similarly to buying, if it's a large company, it's got a high trading volume, it's probably okay to enter this as a market order if you don't have a price down to the penny that you care about. And then once you press buy, it will execute at that current price. Same story though as with buying. There may be instances where you want to set limits on the price you're willing to sell for. Small stocks, you've done your research, want a specific price, or especially doing after hours trading. So then again, once you press a limit, you'll have the same expiration options. Then that's how long it will take, or it will allow the order to be open before canceling it. Now, this is an advanced topic. So selling at a specific price or a stop loss order. So there may be times where you've had a stock for a while. You're feeling like, gosh, I don't need to immediately sell this, but I want to make sure I get at least a certain price if I do need to sell it in the future. And what you can do is actually a great way to protect profits, for example. So let's look at an example of this. You have bought company A at that $100 per share. That's back in the first example. A year has gone by. You're very happy. Company A has gone up in value to $120 a share for a 20% profit. Now, you're happy to continue owning company A. It's a great company. It's going up. Maybe you think it will increase more, but you want to protect some of that profit that you've earned. And so what you can do is you can set what's called a stop loss order. Let's say you want to protect half of your profit. So you'll set a stop loss order at a price of $110. If you set it at this 6-month time frame and the stock never dips below that $110, nothing will happen and you'll continue to own the stock. But if at any time during that 6-month period, the stock touches that $110, it will immediately be sold and your 10% profit will be protected. Buying, there's a similar concept. This is called a buy stop order. You may want to buy at a certain lower price. And maybe it's not terribly close to what's being traded currently, and that's why you might not be able to use a limit. So let's say you've researched company A. It's trading at $100 per share. The price is pretty good, but it doesn't quite meet some metrics that you're looking at. There's things like price to earnings ratio, free cash flow, other things. However, if the price drops to $90 a share, it meets all your search criteria. In that case, you set a buy stop order for $90. And if you set the expiration for good till 6 months and the stock never touches 90, you won't buy it, but hopefully you'll find a bargain somewhere else. But if it does touch that $90 price, you'll feel good that you bought it and have a solid company at a great price. That is it for today. Thanks for watching. And if you have questions, please feel free to email them at info@rowanfinancial.com. Take care.